So what a week we have had in the stock market. If anyone was keeping an eye out on their portfolios this week, this would have been a roller coaster of a ride. As you can see here, this is my trading 212 stocks ISA, and my current balance is £102,019. You can see that over the past 3 months, my portfolio is down by 5.1%, and that is a loss of £5,492. Now this week, things were even worse because at one point I was down by 10.3% overall, or a loss of £11,095. And you can see on the 24th of February, for comparison's sake, I had £116,000 all in cash. So given the current investing landscape, is it still worth to invest in 2025? Now, as you can see here, if the stock market isn't for you, you could always get interest on uninvested cash even within a stocks and shares ISA, and just sit out of all of this with 4.6% currently as an annual equivalent rate on your uninvested cash. Do bear in mind, however, that most of this cash is put into qualifying money market funds, which are again classed as investments, so your capital will be at risk, although they'll be a whole lot less risky than putting your money into the stock market. So if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days but haven't received a free fractional share, all you have to do is to click the 3 horizontal line menu over here. Scroll all the way down until you see the section Use Promo Code, and in this section just enter my code JUBAIR and you should receive a free fractional share. So you may have been wondering what I am invested in order to see my portfolio go up and down over the past week like this. The iShares Core S&P 500, which over the past 3 months is down by basically 10% at this point. And in my portfolio since investing, only 6 weeks ago, it is down by a massive 12.89%, or a loss of £14,601. Now, this sort of loss for a beginner investor can seem extremely huge, and I wouldn't blame you for getting out the market after having lost £14,000 in one go. The reason why I am down so much is basically because I bought it pretty much at the top of the market at £10.13. This is for the GSPX, by the way. If you have a different S&P 500 tracker fund, then things are going to be different for you too. But you can see since then a massive drop in the S&P 500. And the thing is, the crash or the bottom, nobody knows if we've already met it or when it's going to come. So it could realistically go down even more. And it has a lot of people asking the question, is it really worth investing? Why shouldn't we just put our money into a bank which, pretty much guarantees 5% instead of losing 20% in the stock market? Now, the obvious answer would be just to look at the returns of the S&P 500 and just tell people, over the course of, since basically the S&P 500 was open, there were a million reasons to sell out and go into cash instead. However, throughout any significant time period, let's say 10 years or more, investments usually always beat out cash, although there might be some periods where, cash seems to win. But in the long term, something like the S&P 500 has always beaten cash. Now, although our portfolios are down, you can see over the past 3 months, like I said, down by 5.1%, there is some glimmer of hope that we might be seeing very soon, especially on Monday when the stock market opens. Now, this is the President of the United States of America has now exempted smartphones and computers from these tariffs, which is actually a very big, news piece. Now, what this essentially means is that, the president and his billionaire friends have probably got together and said, these tariffs really hurt me and my businesses, so please help us out here. So now companies like Apple, Nvidia, AMD, Microsoft, all the big ones, all the big billionaires that are friends with the president, they are no longer going to be affected, or at least not heavily affected by the tariffs, because they are not on the list anymore. Kind of funny how that works, right? So it is very likely that as a result to this news, the S&P 500, which is highly concentrated in the Magnificent Seven, and what do the Magnificent Seven have in common with, technology? Well, they are all basically technology companies. And if they are excluded off the list of the tariffs, well, it stands to reason that the S&P 500 may not suffer as much as investors had thought. Now, this also makes the President of the United States look a bit weak, because it looks like a step towards retreating away from the trade war that it has basically made against China. As we saw from the last video, the United States President aimed to give China 140% tariffs, and China said they are not going to be backing down. They will not be bullied by the United States of America. But it seems like, this war cannot be dragged out, forever, because the world is complaining and the world is bleeding. And one thing that has made, the president change his mind a little bit is actually the bond market of all things. And a lot of economies around the world are dumping US bonds. And because they are dumping the bonds, the bond yields are, increasing, which is essentially just affecting the United States bottom line. And they can't just keep going on forever like this. But anyway, as a retail investor, as a normal investor, you only really care about if your stocks are going to go up or down. Most people don't care about the politics, although it is quite important at this point in time. So if you didn't know, the S&P 500 comprises of 7 companies which have a disproportionate weighting towards the S&P 500. That's companies like Nvidia, Microsoft, and Apple. And they're all technology based, and they get most of their, components from China. And this tariff would have hurt these companies so much. And, that's why, at least one of the reasons why investors sold off so much. And when people sell off their holdings, that's when the value of the underlying fund also decreases. You can see this was on Friday, after 4:30, that's when the UK markets close, and my ETFs are UK domiciled, which means, they close at 4:30. You can see that the S&P 500 did rise quite a bit. So we are expecting, the UK markets of the S&P 500 to open up higher. In fact, this news was only announced on Saturday, which was after Friday. And since then, you can see that the Dow futures is up. So we can expect, the S&P 500 and the Nasdaq 100 to open up a bit higher. As you can see, I do have this pie here, the EQQQ 100 pound a day fund. And this is down by a huge amount. This is down by 12.86%, so nearly £400 loss. And hopefully on Monday, this will be opening up a bit higher. However, I'm incredibly skeptical that we will be seeing any all-time highs anytime soon, because the thing is, the tariffs are still here. Countries still need to negotiate on these tariffs, and without that blockade getting out the way, there doesn't seem to be much hope of returning back to all-time highs. So make sure to check out some of my other videos, and I'll see you in the next video.